Hi everyone, let's now revise the chapter Meeting of Board and its Powers. So this is a huge chapter containing a lot of sections and very important from your examination perspective. It commences with section number 173. But before we start section 173, let's have a basic understanding of how board takes its decisions. Now, why do board need to take any decisions? Because company is an artificial person and company cannot take decisions on its own, hence the decision making powers are being distributed over board of directors as well as the shareholders, right? Whenever board has to take any decision, that means any issue comes up in front of all the directors collectively known as board, they have to resolve the decision. They have to resolve the problem. So a resolution is passed. What is resolution? Majority or you can say voting happens, right? That is, all the directors have to give their assent or dissent, whether they agree that this should be done or they disagree. If majority of the directors who are present and voting agree, then we consider that board resolution is passed. However, if they don't agree, we consider that the board resolution was put forward but it is lost. So the decisions of board of directors are being taken by a board resolution. Now sometimes section 186, section 203, you also have unanimous board resolution. There is a difference between board resolution and unanimous board resolution, that is UBR. This is that whoever is present at the board meeting, so all the directors present, they cannot refrain from voting, they cannot abstain from voting, they have to vote and they have to vote in favor. So even all the directors present vote in favor, then a UBR is passed. So UBR is not required at all times, it's required in two sections in Companies Act, and in fact it's required under a rule also, but that is not something that we are going to consider right now. Now, how this board resolution will be passed? Undoubtedly, ma'am, all the directors should come together, then the issue will be told to them and then they will resolve the issue. That's how things happen. There is another way of passing board resolution, which is by circulation. That means the decision of board can be taken either at the board meeting or by passing the resolution by circulation. Now this board meeting may be virtual, it may be physical. It may be virtual, it may be physical. Earlier we had this provision that some matters cannot be dealt in at a virtual board meeting, but now there is no such restriction and all the matters can even be dealt at virtual board meeting or the board meeting that's being conducted through video conferencing, right? So this is the general thing. Now, one thing which is imperative from this discussion, which we come to know, is that we must meet, that the board of directors must meet in order to take decisions. And since their meeting is mandatory, they must meet. Companies Act has put in some mandatory requirements about board meeting. Starting from section 173(1), we come to know about the minimum number of board meetings which every company must conduct. See, board meeting is, the matters can take place or they can, directors can vote directly from their place also through circulation, resolution by circulation, but that is something which is not allowed for every matter. There are certain matters for which it is clearly specified that you must meet to take decisions. Okay, you have read section 161. In section 161, there are four parts. Section 161(1), additional director. Section 161(2), alternate director. Section 161(3), nominee director, and 161(4), casual vacancy. Now, out of these four, only 161(4) says that resolution at board meeting. That means this is a section which clearly specifies that the resolution has to be passed at board meeting only and the resolution cannot be passed through circulation. So a lot of times matters are being specifically reserved for board meeting. So for all the other three cases, you may have a resolution by circulation, but not for this one, right? So there are restrictions which have been imposed. Moreover, we have a section 179, which says that certain powers are exercisable by the board only at the board meeting. Okay, so although decisions can be taken through circulation also, but still it is imperative that the board meet, so that all the directors are aware about what is happening in the country, and moreover to take the decisions which are being specifically reserved for board meeting. Okay, now what is the requirement? First board meeting has to be held within 30 days of incorporation, and thereafter every company is going to have a minimum 4 board meetings in every calendar year. In every calendar year. The gap between 2 board meetings is not going to be more than 120 days. So maximum gap 120 days. This is the general rule that we have for all types of companies. However, there are certain exemptions. Now, before I go on to exemptions, you have to understand that even if the meeting is adjourned, that also has to happen within the time limit specified. That means if you call a board meeting, it is adjourned and held after 4 months, the gap between 2 board meetings should not exceed 120 days. So this applies to adjourned meeting also. Now, for Section 8 company, we have the requirement minimum 1 meeting in every 6 months. I hope you understand and remember the difference that I have told you in classes. 6 months and half year. So that's a difference, and you must understand and remember that. So Section 8 company, 1 board meeting in 6 months. OPC, small or dormant company, 1 meeting in half year. Minimum gap should be 90 days. Minimum gap. Here maximum gap was specified, here minimum gap. Now, private company which is startup, again the same thing as of OPC, small company, and dormant company. OPC with 1 director only, the section does not apply. See, meeting, introspecting, all this does not happen when you're talking about company. When you have to take the decisions of company and you are the only one to take decisions, why you will call a board meeting and meet with your own self? Obviously no, right? So you will not meet. Then comes your section 173(2), which talks about video conferencing. That means a board meeting may also happen through video conferencing. I'm not telling you over a telephonic call or a teleconversation. No, it has to be AV, audio, visual, both. So it may so happen. That means a director, if he is unable to attend the board meeting physically, he can also attend the board meeting virtually. So we have a whole procedure which is being listed when the meeting is happening virtually, or when the directors are participating virtually. So what is the procedure that's going to be followed? What are the requirements that are going to be followed? What is needed? So section 173(2) read with rule 3 and 4. So that's how we are going to read it. I mentioned this before that earlier there was rule 4 which prescribed certain matters which could be dealt only at a physical board meeting, but now those matters have been removed. That has been omitted. So now we don't have any matter which is specifically reserved for a physical board meeting. Okay, fine ma'am. So a director can attend in person or can attend through video conferencing only. The only requirement is that whenever a company is going for a virtual meet, it has to ensure that whatever setup it is establishing, it is capable of recognizing the people and recording the director's presence and storing everything along with date and time. Moreover, the chairperson and the company secretary who are responsible for convening a board meeting, they have to make necessary arrangements to avoid any type of failure and should take reasonable care for these. See, whenever a board meeting is happening virtually, it's a welcome move. Undoubtedly, it's a welcome move by the government. But there are issues with respect to confidentiality, security, and other like matters, right? If we are in a closed, compact conference room and a board meeting is taking place, we are sure that no one else who is not entitled or authorized is listening to us. But if we are sitting here out in open and everyone is participating through different places, there might be some insecure surroundings, there might be, right? So this raises a doubt on the confidential matters of any company. However, duty has been imposed on the director as well as the company. That director also has to ensure that you are not around anyone, and the company also has to ensure that the director is sitting alone and only authorized access is being given to the in the board meeting. Right? Fine. So what has to be taken care of? Security and integrity, availability of equipment. All the proceedings will be recorded and thereafter minutes will be prepared. You have to safely keep the records for future. You have to ensure authorized attendance only, as I just mentioned. However, if a person is disabled and requests for an attendant, then that person will be allowed one, and ensure proper audio visual. Okay, so these are the requirements which must be fulfilled, and then only you can go for VC. What is the procedure? And one more thing, is AV mandatory? If a director is unable to attend a board meeting, he requests the company to provide for audio visual facility, and the company ignores and rejects the plea. Is it valid? I would say no. It is mandatory that you provide audio visual or video conferencing facility to the directors if they want that. Okay, for this we also have a case law, Achintya Kumar. Now, what is the procedure? Because normal board meetings, people come, we count, we see things, right? We see things, we hear things, we are in a closed compact room. How the things are going to happen over video conferencing, that is also the procedure which has been laid down. What is the procedure? The first requirement. Well, if you want to call someone for your birthday, for your anniversary, for anything, you must give an invitation, right? Or even if it's not a very formal invitation, you must at least notify. If I want to call you for a class, I will at least have to notify when that's going to happen, where it's going to happen, at what time, place, all these details, right? Likewise, when company wants to call its directors, either physically or virtually, it's their choice. They have to at least inform the directors. How do they inform the directors? By sending notice. What is to be included in the notice? That we will read in section 173(3) later on. In the same section we have the provision of notice also, but right now I am concerned about one particular part in the content of notice, that is an option of VC. So when a director receives the notice of board meeting from the company informing when board meeting is going to take place, he is also given an option that the meeting may be, you can participate in the meeting through video conferencing, and this is the information with respect to that, right? So this is the disclosure that's given in the notice. I have received the notice, so I will attend the meeting. But this is something which is not very common. Although it's becoming common, but I have to intimate the company that I am going to attend through VC, so that company can make adequate arrangements. If I don't intimate anything, it is deemed that I am going to attend in person. Fine. So I informed the company made adequate arrangements keeping all this in mind, and I attend the meeting through video conferencing in the mode as has been specified by the company. What happens is that at the board meeting, the chairman is going to ensure quorum. The next question arises, what do you mean by quorum? Quorum is the minimum number of directors which are required to constitute a meeting. Only then the meeting can proceed. The question is, ma'am, do the quorum need to be physically present or it can be virtually present? See, it may be a situation that all the directors are virtually present. It may be a situation that some are physically present and some are participating through VC. Never mind. The directors who are physically present as well as the directors who are virtually present, they both are counted for the purpose of quorum. So we count the physical directors. If they're present, it's a physical board meeting, right? And that we don't need to compute further, right? So that is how the case is. Once quorum is there, the meeting begins. Then happens the roll call. Roll call is like an attendance. You must have seen a lot of CBI inquiries or police inquiries in movies and web series. What happens? They ask or they interrogate, and the first thing that they ask the accused is that, tell your name. Although I know the name, but still I ask them to tell the name for the record. Right, same thing is happening here also. The directors are being asked to tell their name, the place from their attending the meeting, the fact that they have received the agenda, and the confirmation that no one else is around. So they have to give this for the record. Although the chairman clearly knows that particular director, but still a roll call happens for the record. Then what will happen? Of course, the meeting has started, there will be people discussing, and then there will be voting. So when the people are discussing, there might be these directors also who want to participate and contribute to the discussion. So whenever they contribute, they will identify themselves, and if their voice gets disturbed by any means of disturbance, they will repeat it. Okay. And then voting happens, voting again, roll call, voting. That's how it happens. The chairman at the end announces the summary, and everyone, if they have any objection, they can raise it. After that, the minutes are drafted. That is the true and fair correct summary is being recorded or is being put in writing. Once it is written, it is circulated to all the directors who attended the board meeting. Okay. So they have the chance, they have the option of raising or of commenting on the accuracy within 7 days. If they don't comment on the accuracy, or if they don't have anything to say, it is deemed approval, and if they have anything to say, accordingly they raise that objection. After that, it is going to be entered in the minutes book. The minutes book is prepared under section 118 and is open for inspection under section 119, right, and is signed by the chairperson. Clear? Fine, ma'am. Then we have section 173(3), which talks about the notice of board meeting. See, what are you concerned in the notice? You have to inform the directors. What do you have to inform? Date, place, time, venue, option of VC, and agenda. What are we going to discuss in the meeting? Right? And when we have to inform? That means if the meeting is commencing at 1 p.m, I cannot call at 12 and say the meeting starts in 1 hour at this particular place. Right? A lot of cities where the traffic is huge or commuting takes time, they will not even be able to reach, even if they are willing to and they leave immediately. Then also they might not be able to reach, right? So there has to be a sufficient time given to the directors to prepare themselves for the meeting, to make themselves available for the meeting. So ideally 7 days time is required. So company gives 7 days notice to all its directors. No particular form of notice, 7 days notice in writing to every director, either by hand delivery or by post, which has a proof, or by electronic means at his address which is registered with the company. If you don't give notice, then 25,000 fine on officer in default. Fine. Now I said one particular point with a lot of emphasis, that is agenda. What is it? Agenda is the matter which we are going to discuss. Now, Companies Act does not make it mandatory to give agenda along with the notice. However, as a part of good secretarial practice, it must be sent, and if we talk about the practical world, it is always sent, because the directors must know what are we actually going to discuss. However, this may so happen that 3 agendas are specified and the chairman wants to take up any other matter which is required, and a board meeting is already in existence, so they can take up that matter, right? Simple reason being because the agenda is not mandatory under law. Fine, ma'am. Now, a lot of times this also happens that we don't have time. We don't have time to wait for 7 days to discuss a particular matter, and that's why we want the directors to come together at a shorter notice. So this is also something which is permitted for urgent matters, but there is a requirement. What is the requirement? That one independent director must be present in such a meeting which has been called at a shorter notice. Now, this may so happen that that no independent director is available or no independent director attends that meeting. So there is another solution. What is another solution? It is supposedly a shorter notice is given, meeting called, no ID attends it, no independent director attends it. So circulate the decision to all the directors, and if at least one independent director ratifies it, then it's going to be valid. Ma'am, what about the companies in which we don't have independent directors? This is not the requirement, so you can call the meeting at a shorter notice. Simple. Okay. So this restriction has been placed on those type of companies only which have independent director. Okay. Sometimes students have this confusion that, ma'am, can board meeting be held on a holiday? Yes. Can it be held outside business hours? Yes. Can it be held outside the city or registered office? Yes. It can be even held outside India. Okay. So board meetings, that is something which is very well possible. Okay, fine. Now, Section 173(4) is only about the penalty that I've already told you. Moving on to the next part, Section 174, that is quorum of a board meeting. Quorum is the minimum number of members which are required to constitute or to validly conduct a board meeting. 1/3 of total strength or 2, whichever is higher. Although articles may specify an even larger or higher quorum, articles don't have the power to specify a lower quorum as it will be non-compliance of law, but it can specify a higher quorum. So articles may say that in my company the quorum will be 5 directors. So irrespective of what section 174 says, you have to have at least 5 directors to constitute to conduct a board meeting. Fine. Okay, fine, ma'am. Now, what if the quorum is not present? What is going to happen? The meeting will be adjourned. If quorum is not present, the meeting will be adjourned according to what articles say. If the articles don't say anything, it will be adjourned to same day, same place, same time next week. Supposedly at the adjourned meeting also quorum is not present, the meeting will be cancelled. In general meetings, we have read the opposite. What we have read in general meetings is that if in the adjourned meeting also quorum is not present, the members who are present shall be deemed to be the quorum. This is not the case in case of board meetings. Fine. So in board meetings and general meetings, this particular provision is different. Fine. Okay. Now one more thing that you have to understand, that what is interested directors? Who are interested directors? We have a section 184, in which we talk about the disclosure of interest in like things. See, there might be a situation that I am a director and the company is entering into a contract with my father. So I would definitely want that this contract should take place because I'm interested. Somehow I have an interest, and therefore my discussion, any contribution to the discussion, any contribution to the voting cannot be unbiased. Or even if I am so competent to be unbiased, others might not believe it, right? They will still have the feeling that I will give a biased opinion only. So Companies Act prevents such a situation and tells the directors who are interested to not be a part of such meetings, to refrain yourself from participating in such meeting and voting in such meeting in which you are interested in any contract. Okay, fine, ma'am. Now, supposedly there are 9 directors, and out of which 2 directors are interested. So 1/3 of 9 comes out to be 3 or 2, whichever is higher. So out of these 7 remaining directors, you can have at least 3 directors who are present and they will constitute the quorum. That's not a problem, because interested directors, since they cannot participate in the meeting, they are also not a part of quorum. Fine. But let's imagine a situation. There are 9 directors and out of which 7 directors are interested. So if I calculate 1/3 of 9, it will be 3. We don't even have 3 directors who are not interested, because 7 directors are interested. We just have 2 non-interested directors. So in such a situation, there will never be a quorum. So for this situation, it has been specified that if the interested directors at any time is more than or equal to 2/3 of the total strength, then higher of number of disinterested directors or 2 directors shall be the quorum. Okay, it shall be the quorum. Now, one relaxation in private companies, because in private companies you will be interested in almost all the contracts and you are only the member, you are only the director. So if you are interested, you are allowed to vote. It's just that you have to give proper disclosure. So this does not apply to a private company. Now, for section 8 companies, quorum is different. 25% of total strength or 8 directors, whichever is lower. However, in no case it shall be less than 2. Okay. Now let's imagine a situation. Ma'am, my articles say that you need 5 directors to be the quorum and I have only 3 directors. So how? Because my 3 other directors have died. So how can I get 5 directors? How can I conduct a board meeting? In such a situation, you can call a board meeting even with lesser number than the quorum to increase the directors or to call general meetings. So for these 2 purposes, even if there is no quorum, the directors may act. Okay. Section 175. Passing of resolution by circulation. One thing that I have already told you, that resolution by circulation is not allowed in all cases. For the cases where it has been specifically mentioned that you have to deal with this item at board meeting only, then board meeting is needed. We are reading about the notice, we are reading about the quorum, all for the board meeting, not for passing resolution by circulation. So here we don't have any such requirement. What is the process then, ma'am? You draft a resolution, attach necessary papers which help the directors to take a decision, and send it to all the directors by hand delivery, post or email at their address. If you get approval by majority, then in the subsequent board meeting you will note it and include it in the minutes that such a resolution was passed. Okay. Sometimes it may so happen that I have received this draft resolution and I sincerely feel that this is a matter which should be taken up at the board meeting because it needs a lot of discussions. So, if 1/3 of directors require that the resolution should be passed at board meeting, then chairperson shall decline this particular thing and they will call a board meeting and the matter is going to be decided at the board meeting. Clear? The matter is going to be decided at the board meeting. Then comes your section 176, a very small section which just talks about the defects, or you can say validity. See, a lot of times it may so happen that we appointed a director, his appointment was defective, or some disqualification gets attracted to him, or he has to vacate some office, some grounds of vacation has been attracted to him, but he doesn't know. The company is not aware. In such a situation, he continues to act as a director even during that period of disqualification for say 6 months, 7 months. Now during this tenure, he has passed a lot of resolutions, he has taken a lot of decisions, he has entered into a lot of transactions with other parties, third parties. Once we come to know that his appointment was defective, that means he was not a director, proper director, and that means all the acts that he has done as a director are not proper. That means we have to reverse all the acts. The answer is no. Section 176 gives us a clarity that if the director appointment was invalid by reason of defect, disqualification or termination, then whatever acts are done by the company till whatever acts are done by the director till company becomes aware of it, they shall be deemed to be valid. Okay. So after his appointment has been noticed by the company to be defective, thereafter all the acts will be invalid, but before that the acts will be valid. Okay. Before that the acts will not be considered to be invalid. Just a second. I try hard not to waste your time because I understand you are into such heavy professional studies, and at this particular time, if at this particular point, if I am asking you to devote 1 hour with me, then I have to understand the importance of that 1 hour, and I cannot be like only half an hour to be productive and half an hour some chit chat or this example or that joke. So I refrain from cracking a lot of jokes when I'm into serious studies. Of course, for the flow, for keeping the classes entertaining, you know that we need stories, we need jokes, we need situations every now and then, so that has to happen. But of course, when I'm doing this continuous revision, I don't want to waste your time, and that's why I am trying to be as quick as I can. If you still want that the flow should increase somehow, you can increase the speed, but I wouldn't a lot suggest you that. For the topics wherein you are very confident, you may skip this revision, you may increase the speed, but for the topics you are not very confident, then this is going to help you only, right? So you can revise along with me. I'm trying to cover all the aspects of all the complete section. I'm not leaving anything for you. Now, section 177, audit committee. See, 177 has two aspects, audit committee as well as vigil mechanism, and section 178 has NRC and SRC. First, we'll talk about section 177, audit committee, or as of that matter, any committees that we're talking of. What are these committees? They're nothing but a group of directors of the same company. So they are dedicatedly being appointed to the cause of something. When I'm talking about audit committee, they have been some directors who have expert knowledge in finance or who understand finance, who understand the financial statements and all, who understand how audit is being conducted, what is the importance of audit and like things. They are being included in this committee. What do? They see that which auditor should come, so they can give recommendation with respect to auditor, his remuneration. They can see how audit is being performed. They can see other internal controls of the company. They also have to approve some related party transactions, right? So they investigate into certain matters. So not just audit, but overall control of the company. So they have certain powers and they have some certain functions that they need to discharge. So they are going to oversee all those things. Okay. Ma'am, do we need audit committee in all types of companies? The answer is no. See, as the company grows and expands, then you need specific expertise areas. Otherwise, one person can handle it all. One person can handle audit also, he can handle the employees also, he can handle the operations also. So even if you have two directors, they can handle everything. But as company grows, you need different dedicated team to handle things. So the companies which are required to appoint independent directors, the same companies are also required to constitute audit committee. Okay, that means listed public companies or public companies which have paid up capital of more than equal to 10 crores, turnover more than equal to 100 crores, loans more than 50 crores. So these companies are required to constitute audit committee, which is mandatory. JV, that is joint venture, wholly owned subsidiary, dormant, not applicable to them. So they are not required to constitute. Now, we need to understand what is going to be the composition of audit committee, what are the powers that they have been given, what are the functions that they need to discharge or they need to perform, any disclosure and punishment for not doing it. The punishment is not given over here, it is given under section 178. So we don't have any punishment which has been specified in section 177. For the for contravention of section 177 also, the punishment is stated in 178 only. Okay, now composition. Minimum 3 directors, of which majority shall be independent and with the ability to read and with the ability to read and understand financial statement. They have to be financially literate, not just literate. Okay. What do? They recommend auditors' remuneration. One important point to note over here that they recommend. They cannot impose their decisions on the board. It is board's discretion only whether they want to appoint or nominate the auditors. Appointment of auditors is a matter of ordinary business which is being dealt at the general meeting of the company, but board nominates the name of the director, nominates the name of the director, nominates the name of auditor. This name is being suggested by the audit committee. When an expert is giving you a recommendation, you must follow it. Although it is your life, your decision, you might not follow it. But when you reject that expert's recommendation, you must have a strong backing reason for that. The same goes for the board. Board, if you are rejecting, if you are not accepting the recommendation of audit committee, you must disclose the reasons in the board's report why not, along with the composition of audit committee. Fine. So they recommend, then they review auditor's performance, how the auditor is performing, so that we can give a feedback, no, this auditor is not correct, we should not reappoint this auditor, or this is performing brilliantly, what is happening, right? Then examining the auditor's report. If auditor has given any qualification in his report, then you are going to discuss it with the auditor, why this particular qualification has been given. If it is a clean report, no problem at all. Right, but then you will see on what aspects auditor has examined, on what aspects auditor has not examined, what are the things that are happening in the company. So it also acts as a bridge between the management as well as the auditor. Then scrutiny of loans, assets, internal control, monitor use of public funds, additional things, and approval of related party transactions. So section 177 out here is read with section 188. Is read with section 188. One by one we'll do it. Now, to discharge all the functions, you also have been given certain powers. You can call for comments of auditors, you can review financial statements, you can discuss issue with the auditors, you can investigate and oversee vigil mechanism. We'll do this later after we do this. Fine. Now, what is related party transaction? What is related party transaction? For this, you need to understand what is a related party. Section 2, clause 76 defines related party. Company, the director of company, relative of director. KMP is relative. any firm in which they are a partner, any private company in which they are member or director, any public company in which director or manager is the director and holds more than 2% of paid up share capital of the company along with its relatives. Then any body corporate according to whom you are acting, or the body corporate who is acting on according to you. Then we have holding subsidiary, associate, investing company, subsidiary of holding, any other as may be prescribed. So all these are related parties. All these are related parties. Company enters into a contract with the related party. Company is buying some goods from related party. Now this is a contract which is specified in section 188. I'll repeat. Section 188 has 7 specified transactions if entered into with related party needs approval. Approval from audit committee, approval from board, and if ceiling limit exceeds, then approval from members also. So audit committee approval, board's approval, as well as members approval if ceiling limit exceeds. Members approval is needed only if ceiling limit exceeds, right? That means you need audit committee's approval also. So audit committee will grant the approval. Fine, ma'am. Audit committee has an option to give omnibus approval also. What is omnibus approval? It is one-time approval. See, if the transaction is not covered under section 188, of course you don't need to give any approval, you can only give recommendation. If the transaction is covered under section 188, then you need approval. But even within that, if the amount is less than 1 crore and you don't take approval from audit committee, then audit committee can ratify it within 3 months, and if not, it is going to be voidable at the option of audit committee. But if the amount is more than 1 crore and the transaction is specified under section 188, then either you can take approval transaction wise, or you can take prior approval for maximum 1 year. Okay. For this, audit committee is going to check how repetitive the transaction is and how justified the transaction is. So based on that, they will give prior approval for the whole year, that okay, this is the maximum value, that during the whole year, maximum up to 1 crore you can enter into transaction, or maximum up to 10 crores. Per value transaction is not going to exceed 1 crore. You have to make these disclosures. These transactions are not permitted, and I'm going to review from time to time. Okay, so this, by imposing such conditions, audit committee can grant omnibus approval for related party transactions which need approval under section 188. Clear? If you contravene this, penalty is there. This is the penalty which is given under section 178. Clear? Now, audit committee is also required to oversee vigil mechanism. What do we mean by vigil mechanism? Vigil mechanism is set up for the benefit of employees, for the benefit of directors, so they can report their concerns, their grievances directly. A lot of times it happens that employees are being caught in the web of manager or the exact upper hierarchy. They don't have the access to move to higher authorities. They don't have any access to complain. They don't have any medium to complain, right? Even if they go to their own manager for complaining about him only, he's not going to listen. So for such purposes, for the companies, if your company is a listed company, if your company has accepted public deposits, or if your company has borrowings more than 50 crores, then in these situations it is mandatory for the company to establish vigil mechanism. Okay, now vigil mechanism is just a system where you can register your complaints, where you can have access to people who will listen and resolve your problems. For the companies which have audit committee, Audit committee oversees the vigil mechanism. In many companies, it may so happen that you don't have audit committee, but because you have accepted some public deposits, you are required to establish a vigil mechanism, and therefore you do it. So in such a situation, the board is going to nominate a person to oversee vigil mechanism. It also happens a lot of times that people take undue advantage of the system and they file unnecessary or frivolous complaints. So in such a situation, action will be taken against that employee also. I'm sorry. Clear? Fine. So this was about section 177. Now we move to section 178, NRC and SRC. Who is required to establish NRC and for what reason? NRC is again being established by those companies who are required to have independent director or who are required to constitute audit committee. So the same companies are also required to constitute NRC. What is NRC meant for? NRC is going to identify persons who should be appointed as director, who are deserving ones, who are required in the senior management, who should be removed. Formulate the criteria. In fact, even develop the criteria for evaluation of the performance of board, that he is a director who is performing really well, or he is in the senior management, he can be promoted as a board of directors. So this is the criteria that I have developed for evaluation of performance, like who attends at least 7 board meetings. So this is the criteria that they have maybe set up. Now this can be evaluated by them only, or it can be evaluated by some external agency also, or by the board also, right? So all this is the function of NRC. The composition of NRC is slightly different than audit committee. Here you need 3 directors, only non-executive directors, 3 or more, at least 3 non-executive directors, of whom half shall be independent directors, Now whoever is the chairperson of the company can become the member of NRC, but he will not be the chairperson of NRC. He is the chairperson of company, he is an executive director, he can still be the member of NRC, but he will not be the chairperson of NRC. Clear? Okay. Then we have stakeholders relationship committee. Ideally, when we talk about stakeholders, we include everyone, be it government, be it our suppliers, be it our employees, be it our vendors, all of that. But here, stakeholders mean the persons who have invested into the company. They are the security holders, they are shareholders, they are deposit holders as well, they are debenture holders, they are any other security holders. So collectively, if this number exceeds 1000, then comes the requirement of SRC, that is Stakeholders Relationship Committee. What are they going to do? Vigil mechanism for the reporting of complaints by employees. This is also for reporting of complaints or grievances or problems of stakeholders. Some might not have received the dividend, some has the issue with respect to share warrant, etc., etc. There can be ample of things, right? So they can file their grievances. Stakeholders Relationship Committee, a group of dedicated directors who are going to oversee that all the problems are being resolved or not. So the basic idea is to protect the interest of all security holders, okay, not just your equity shareholders, but all the shareholders, right? Now sometimes it may so happen that I'm genuinely trying to resolve a problem, but the other person is not listening at all or is in some other angle. So if you have tried to resolve the problem in good faith and you are unable to do that, then it will not be deemed to be contravention of the same. Okay, so no contravention if inability to resolve the problem in good faith. You have the penalty. What is the penalty? 5 lakh and 1 lakh. Section 177 plus section 178. So if you contravene any of the provisions of these sections, then this is the penalty. Penalty on company 5 lakh and penalty on officer in default 1 lakh. Right? Now, section 179, powers of board, or I can say powers exercisable only at a board meeting. See, first thing that you need to understand for this section is that what board of directors can do. Anything that a company can do, its board can. What company can do? Company has to comply with Companies Act. The board also has to comply with Companies Act. Company has to act within the purview of its memorandum of association. So will the board. So you have to understand that anything that a company is permitted to do, its board can do. But there are some powers or there are some acts which only shareholders can do. Like altering the articles of association. A company is permitted to alter its articles even after it has been drafted, but this power has been specifically reserved for the shareholders. So such a thing cannot be done by the board of directors. So all the acts which a company can do within Act, MOA, AOA, or any regulation which the shareholders have imposed in general meeting. So within these powers, board can do all the acts which company can do, but board cannot do the things which are specifically reserved for the shareholders. Now, so board has ample of powers. Out of these ample of powers, there are certain things which have to be dealt at board meeting only. These powers cannot be exercised, or these matters cannot be dealt through resolution by circulation. Okay. So BR in BM is needed. That is, board resolution and board meeting is needed for transacting these items. That means whenever you want to call money on shares. See, I have given you a mnemonic of learning this. I hope you remember that and you have learned this well. Calls on shares, buyback, issue of securities, approval of merger, diversified business, approval of financial statements, political contribution, takeover, appointment of KMP, internal statutory auditor, removal of KMP. And then you have big powers. Borrowing money, investment, and giving loan guarantee security. These two are covered in section 186 and this is covered in section 180. So section 180, company can borrow, company can give loan, company can invest, company can give guarantee, company can give security. Company can do this. It is not such that these things are not permitted. These matters can be dealt only at a board meeting. However, these three big powers, BIG, big powers can be delegated. You call a board meeting, you pass a board resolution, resolved with that, the power to borrow money has been delegated to managing director of the company. He is now empowered to borrow money on behalf of the company. The maximum amount that he can borrow is this, etc., etc. So by imposing all those conditions, you can delegate the power to a managing director, manager, commercial, the principal officer of the company or branch, right? He can be a director also. So I hope that's clear. Now, board of directors has all the powers which company has, subject to act, memorandum, articles and regulations. Now, there are around 13 matters which require board resolution at board meeting. Only then they can be discussed or they can be dealt with. Out of these 13 matters, there are 3 matters which can be delegated, right? Now, we come to section 180, borrowing. This is the major thing that is given in this section. Section 179 tells us that the company can borrow, but to borrow it has to hold a board meeting. However, it may also be delegated to someone, but whatever power is delegated, it has to be within the limit which is given in section 180. What does section 180 tells us? Section 180 restricts the general and vast power that has been given to the board. The board can borrow. The board can borrow money. Section 180 tells, hold on, you can borrow only up to this amount. If you want to borrow more than this, you need to go to the members and take special resolution. You need to pass SR and take their approval. Moreover, you also need SR for these things. So in these 4 cases, SR is needed by the board of directors. Case number 1. Company wants to sell its undertaking. What is undertaking? Undertaking is a separate unit. How do we identify whether a particular venture is an undertaking or not? If that particular venture is giving you or is worth 20% of net worth, more than 20% of net worth, or it's generating more than 20% of income, then it's an undertaking. So if you want to sell off that undertaking, the board cannot take decision on its own. It has to go to the shareholders and get a SR passed. If the company wants to sell only substantial amount of undertaking, not the whole undertaking, but a substantial amount of undertaking. What is substantial amount of undertaking? 20% of that undertaking. So if you want to sell that, then also you need SR. Clear? Sometimes on merger, you have received some amount. Company has received some amount. Now you want to use this amount for some purpose. It's not your money, it's the money of shareholders. You need to take their permission and then only you can use this amount. Supposedly, company has given some loan to a director. Now, can company give loan to a director? Yes, subject to section 185. Subject to section 185. Supposedly, company has given loan to a director and now the director is unable to repay. The director comes to the company and says, I need 1 more year. The board says, okay, fine, take it. Today is your day, tomorrow our day will come. No. The board does not have the power to give extension to the director. For this, you need SR. And lastly, if the amount of borrowing exceeds a particular limit, what is the limit that has been given? Borrowed plus proposed exceeds paid up capital, free reserves, securities premium. If this exceeds, then SR is needed. If it does not exceed, then SR is not needed. That means if your total borrowings are less than equal to paid up capital, free reserves or securities premium, then you don't need SR. If it exceeds that particular amount, then you need SR. In this section, in this particular point, we have a concept called as temporary loans. Temporary loans. What are they? Temporary loans. Like you have any short-term loans, they are not going to be part of that borrowing. For example, if there are short-term loans 50 lakhs, and then you have long-term loans again 50 lakhs, and the company proposes to borrow further 50 lakhs. So how will I compute this limit? I will say that my existing borrowings is 50 lakhs and my proposed borrowing is 50 lakhs. So 1 crore is the total borrowings. Now if this amount exceeds this, then I need SR. So I will also calculate paid up capital plus premium plus free reserves and I'll see which one is higher. If my borrowings is less than or within that limit, then I don't need SR, otherwise I need SR. Okay. Section 180 does not apply to a private company. So in private company, the board can borrow any amount that they want to. They don't need to get any special resolution. So for private companies, you can borrow any amount that you want to. There is no restriction or there is no limit which has been imposed. Fine. Section 181. Contribution to bona fide or charitable funds. This is a very small section. Company wants to contribute to these funds, you can. If you want to contribute up to this particular percent, it is within board's limit, and if it exceeds more than 5%, then you need OR, and then you can contribute. Then comes your section 182, which is political contribution. Again, a lot of students have this problem that, ma'am, why political contribution is so liberal that any amount, you can contribute any amount. So I have told you the logic behind this, right? See, any company other than government and a company which has been in existence for less than 3 years, they can contribute, they can give any amount they want to a political party. It's just that cash contribution is not allowed. They have to either contribute through check, draft, ECS or instrument. So they can. They just have to disclose in P&L account. Okay, fine. Contribution to National Defence Fund. This is an overriding section. It overrides everything. It says that if company wants to contribute to NDF, National Defence Fund, or any other approved fund for defence, go ahead. Even if your articles restrict you, then also you can. There will be no contravention, absolutely no. Okay, fine, ma'am. If you contravene this, there is a penalty. This reminds me, if you contravene section 179, section 180, section 181, that is powers of board, then you have restriction on powers of board, and even if you have charitable contributions. These three sections that we read before, they don't have any penalty which has been specified. That means, ma'am, we have been given that we have to discuss this matter at board meeting only. But supposedly we don't discuss this matter at board meeting and we pass a board resolution by circulation. What is the penalty? You have the penalty which is not specified for the section. So you go to a specific section of penalty, which is section 450, general section of penalty. So for all the sections where a specific penalty has not been specified under Companies Act, we have a general section, section 450. Now, disclosure of interest by director. A director has to give disclosure of interest. For this, again, we come back to our related party. For the students who have not done very thorough study, might not understand that what is the connection between related party and section 184, ma'am. Section 188 is for related party, section 184 is not for related party, but you have to understand that there may be situations when both the section applies. Why? Because we have interest in our related parties. No matter how much we say that we are interested in our neighbors or this or that or this or that, no, we are interested in our family, our relatives, our people. Right? If my mother is being appointed as one of the employees of a particular company, I'll be interested in that contract. If some XYZ person is being appointed, I'll not be interested. So my interest is somehow connected with related party, though it may not always happen so. Now, if I am a director, I have to check in which companies I have the holding, in which firm I am a partner, where body corporate, where association I'm interested. And I have to give all these details in the first board meeting in which I'm participating as a director. I've been appointed as a director. In the first board meeting that I participate, I have to give this disclosure. Thereafter, every year in the first board meeting, I'll give disclosure. And if there is any change in my interest, then after the change in interest, the first board meeting that happens, there also I'll give disclosure. So I have to give disclosures in this manner. The form specified is MBP 1. I give the disclosure. The company maintains a register MBP 4 for recording these things. Okay, fine. There is another subsection, section 184(2), which is more important for examination point of view, that deals with specific disclosure. Specific disclosure. Now this is when the company enters into a contract or arrangement with body corporated firm and the director of the company is interested in such body corporate or firm. Now this interest has been specified. Section 184 interest has not been specified, so you have to give disclosure in all respect. But here you have to give disclosure only when you hold more than 2% of paid up capital, or your promoter or manager of CEO and partner or owner of the firm in case of firm. So you have to, if above situation arises, then this director must disclose his interest in the board meeting in which first time the contract is discussed, and he shall not participate in it. Supposedly there is contravention of the same, the contract becomes voidable, such director has to vacate office and there will be a fine of 1 lakh on interested director. On interested director. Okay. Again, it does not apply to private company, because in private company the directors who are interested, they can vote. After giving the disclosure, they can vote. Fine. Moving on to our next section, section 185, that is loans to directors. See, the first thing, company is prohibited to give loan, guarantee or security to the directors of the company, the directors of holding company, the relative of such director, partner of such director, and a firm in which such director or relative is a partner. So you cannot give loan, guarantee or security to your director, to your directors of holding company and to other concerns in which the directors are related. This is the logic, this is the section which it says, but then it has exceptions. See, section 185 deals with such a situations when there is loan, guarantee or security to the directors or its concerned entities. If the director is not related to any entity, this case does not fall under section 185, because section 185 deals with loans to directors, etc. So we are talking about loans, giving loans to director directly or giving loans to the entities in which such director, in which director is interested. So one is that prohibition, you cannot give to these people. Second is that you are permitted to give to certain people in which director is interested if you pass SR. If you pass SR. Okay, ma'am? Permitted to give loan to or guarantee or security to private company in which director is a director or member, body corporate whose board acts according to us, and body corporate in which we hold more than equal to 25% of voting power. So you can give to such entities in which director is interested. Loan can be given to such body corporates in which the director is interested if explanatory statement is given to the members and SR is being passed. Clear? Now, it's not applicable to private company if no body corporate has invested in that private company and the borrowings are within this limit and there is no default. It is also not applicable to government company if they have obtained the necessary approval from their respective ministry and no default of filing. Moreover, it is not applicable if loan is made to MD or WTD as employee. They are executive directors, right? That means they are employees of the company. So just like advance salary can be given to other employees, it can be given to these directors also. So fine. There might be some scheme which has been released by the company, and in pursuance of that scheme you can take loan. So you can take loan, not a problem. There might be a situation when you give loan in ordinary course of business like NBFC or banking company. It is their business to give loan. So just like they give loan to other customers, they have given loan to director also. But obviously, when you give loan to your internal employees, to your internal directors, you give loan at some reduced rate. In any situation, your rate should not be less than the government security yield. If you will give loan to your wholly owned subsidiary, if you give guarantee to your wholly owned subsidiary, guarantee or security to your wholly owned subsidiary. So these are the exceptional cases where it is permitted, right? Where it is permitted. Moving on to next section. Loans, investments, etc. by a company, a very small section, section 186, or rather I would say it has two perspectives. Sorry, 186 is not a small section. It has two perspectives. One is putting a restriction on layering of investment companies, and the second is LGSI limit. First thing you need to understand for this section is what do you mean by investment companies, and since you have to understand about investment company, I'm going to take you over here. Investment company is what? Whose principal business is investing. How do you identify whether a company is investment company or not? See, if I want to check, I open a balance sheet of any company. If that's a factory, it will have a lot of assets as plant and machinery. So I come to know, okay, a lot of manufacturing is taking place in this company. Likewise, if I open the balance sheet of an investing company, I will see a lot of assets as investments only. So more than 50% shall be them. Or if I check the P&L account, I will see more than 50% of its income is coming from that investment sources only. Right? So that's how I identify whether a company is an investment company or not. Although we can talk about any type of company, there is a restriction on number of layers of subsidiaries. But this section 186 talks about investment companies only. It restricts the number of layers of subsidiaries to maximum 2. It does not mean that a company cannot have more than 2 subsidiaries. Undoubtedly, it can have hundreds of subsidiaries, but it cannot have more than 2 layers of subsidiaries, which means a company has a subsidiary, this company has another subsidiary, and this company has another subsidiary. So layer 1, layer 2 and layer 3. So layer 3 is not permitted. Fine. There are exceptions. What are the exceptions? Banking company, NBFC with net worth more than 500 crore, government company, insurance company. These are the exceptions. One more thing, that wholly owned subsidiary is not counted as a separate layer, that is merged with that company only. And we have a company, this company acquires a foreign company. It becomes a subsidiary. Now this foreign company already has 5 subsidiaries, 5 layers of subsidiaries, I would say. 1, 2, 3, 4, 5. And this is something which is permitted in that country. So this foreign company is not doing anything unlawful. It is a lawful act. And now you want to acquire, you want to make this foreign company as your subsidiary. An Indian company wants to make this foreign company as their subsidiary. You can. So if Indian company is a foreign company, if the investing company is a foreign company with permitted more layers as per foreign law, it is allowed. Now we have other provisions of section 186. This is LGSI. Loan to any person or body corporate, guarantee with respect to the loan, security with respect to the loan, or investment in body corporate. This is shortly known as LGSI. For this, you need unanimous board resolution. So for giving loans to anyone, for giving guarantee, for giving security, or for investing in any body corporate, you need UBR. More than that, apart from UBR, if the ceiling limit exceeds, you also need approval from members. You also need approval from members. So what are the cases? UBR is must in all cases. If LGSI made plus proposed does not exceed the limit which has been specified. What is the limit? This is the limit. Higher of 60% of paid up capital plus free reserves plus securities premium, or 100% of free reserves plus securities premium. So you check this limit, you compute this limit. If your LGSI, which is already there plus proposed, exceeds this amount, you need SR. If it does not exceed this amount, no SR is required. Okay. Now, if it does not exceed the limit, no SR needed, you just need UBR. Plus you need PFI approval if there is default in repayment. If there is no default in repayment, no problem. Fine. But if your LGSI exceeds this limit, you need UBR. You also need SR, as well as you also need PFI approval. Ma'am, even if there is no default, yes. If it exceeds limit, you need PFI approval also. Fine. Apart from this, whatever loan you are giving, at least this has to be the rate. The minimum rate is going to be at least yield of government security closest to the tenure. Right, when we compute this 60% of paid up share capital, we have to take capital as both preference plus equity, as well as we deduct call scenarios which have not been received, because we are computing paid up capital. So whatever has been received, that only is taken. There has to be no subsisting default with respect to deposits. If there is, you cannot go for LGSI. Disclosure has to be fully made in the financial statements. Okay, full disclosure in financial statements. Apart from this, there is a register for LGSI which is being maintained, MBP2. This register is also going to be open for inspection by the members, and there is contravention. If the company contravenes these provisions, minimum fine 25,000, maximum 5 lakhs. So your fine can range between this. On the company and officer in default, imprisonment less than equal to 2 years, and again fine between that. Fine. Section 187, a very small section. Whatever investments you are holding, whatever assets you are holding, whatever securities you are holding, it has to be in your own name and in your own possession. Simple. That is the general rule. So company, if it is holding any investment, it has to be in company's name only. However, there are certain exceptions. Sometimes it is important that you have, for compliance of law, you have to hold it in your nominee's name, hold shares. Sometimes you give it to the bank for collection of dividends. Sometimes you have to transfer it to the bank for facilitating sale. Sometimes you transfer it, rather give it as a pledge for obtaining loan. Sometimes when your shares are in demat form, you're not the registered owner, your depository is the registered owner and you're just the beneficial owner. So in these situations, investments might not be in your own name. For this, you have to prepare a register in MBP3, which is going to be kept at the registered office, preserved permanently, and is going to be open for inspection. Section 188, again we have a punishment also for this, 5 lakh and 50,000. Okay. Section 188, related party transactions. Now, see, whatever transaction is happening between the company and its related party, not all the transactions are covered under section 188. First of all, if they are at arm's length price in the ordinary course of business, they are not covered. Secondly, if they are not at arm's length price in ordinary course, then we have to check whether they are covered under the specified 7 transactions. What are the specified 7 transactions? Sale, purchase or supply of goods or material, disposing of property, leasing of property, availing or rendering of services, then with or without agent, that is clause E. Then appointment of OPP, office or place of profit, underwriting of securities. So these are the 7 specified transactions. If the company enters into a contract or arrangement with related party, the transaction which is specified under section 188, you need BR. If it exceeds the limit, you also need OR. Simple. For BR, notice of BR will be, notice of board meeting will be sent with agenda explaining everything, at board meeting resolution will be passed. The interested director is abstained from participating and voting. Next thing is we have to check whether it exceeds the limit or not. If it exceeds the limit, then notice of general meeting will be sent along with the explanatory statement, and the ordinary resolution will be passed. Related member will not vote. If it does not exceed, no OR is required. No OR is required. Right? Transactions between 100% subsidiary and holding, no OR is required. Whatever transaction is being entered with the related party will be adequately disclosed in board's report. The next question arises in our mind that, now, what is the limit? What is the limit? If it exceeds limit, we need OR. But what is the limit? The limit, sale purchase of goods material with or without agent, more than equal to 10% of turnover, OR. Property more than equal to 10% of net worth. Leasing more than equal to 10% of turnover. Services more than equal to 10% of turnover. 2,50,000 per month and 1% of net worth exceeds that. Now, if the contract needed approval from board or approval from members, but that necessary approval was not acquired and the transaction took place, the contract was entered into, what happens in that case? Does the contract become void? The answer is no, it becomes voidable. First of all, it can be ratified within 3 months. Even if it is not ratified, it becomes voidable at the option of the board or the members, whatever the case be. Right? If there is any director who is involved, he is going to indemnify the company for the loss. Okay. You have the penalty. In case of listed company, 25 lakh. In case of unlisted or others, 5 lakhs. Right. Now we have very small sections remaining. Section 189, the register. So for section 184, for section 188, you have to maintain the register, MBP 4. The register is going to be preserved permanently, kept in the custody of company secretary. When we give disclosure under section MBP 1, that details are going to be included in the register. Register will be kept at the registered office. It is going to be open for inspection, produced at every general meeting, and there is a penalty for non-maintenance, that is 25,000. Then comes section 190, which talks about the contracts of employment with MD or WTD. See, whenever a company is appointing MD or WTD, it enters into a contract of employment. If there is no contract of employment, then it will at least have a memorandum of understanding where the terms are being boiled down to writing, right? Whatever it is, it has to be kept at the registered office of the company, and which is going to be open for inspection for members. This is not for private companies. So only in public companies this is going to be an open thing for members, right? Again, there is a penalty, fine less than equal to 25,000 and 5,000 respectively for company and officer in default. Section 191 is somehow related to 202, because here we compensate for the loss of office. Section 202 gives compensation only to MD, WTD and manager. However, this section gives compensation to all the directors. In case of sale of undertaking, sale of shares, takeover, there is any loss of office to the directors, then they can get compensation which is not going to exceed the compensation given under section 202. So within that limit, the compensation can be given. Compensation can be given undoubtedly to the executive directors as well as non-executive directors. So when I'm talking about executive directors, there is some restrictions. Since they are involved directly in repayment of deposits, repayment of debentures, repayment of bank loan, taxes, then payment of employee dues or dividend to preference shares or redemption of preference shares, if there is any default in all these, they will not be entitled to get compensation. The non-executive directors will still be entitled, but they will not be entitled, right? Moreover, an additional point to note over here is with respect to the quorum. Usually, see one more important thing. When we are talking about section 191, we give compensation to all the directors by passing ordinary resolution. So when we are passing ordinary resolution, it may so happen that the meeting was adjourned, and at the adjourned meeting also the quorum was not there. So deemed quorum and the resolutions were passed. This shall not be passed. No deemed approval in case of this section. Okay, penalty 1 lakh. Then we come to section 192. Restrictions on non-cash transactions, that is a kind of barter system. Again, this is not going to happen unless OR is passed. So if you want to enter into any transaction with a director which is non-cash, you have to take prior approval by OR, and the value shall be determined by the registered valuer. If it is not so obtained, if the approval is not so obtained, the transaction will be voidable at the option of the company. Okay. Lastly, we have section 193, that is contract by one person company. It is absolutely nothing. One person company is entering into a contract with the sole member who is the director also. So what disclosures you will give, what board meeting you will hold, what permissions you will take, nothing required. You just have to enter it in the minutes book, and you have to inform the ROC within 15 days about the transaction into, because he is a related party, right? So that's how things will take place. That's it with this particular chapter.